Florida's real estate market has been the envy of the nation for years, a sun-soaked paradise where property values seem to defy gravity, climbing relentlessly upward while the rest of America watched in awe. But beneath the palm trees and pristine beaches, a slow-burning fuse is racing toward detonation. Insurance premiums have tripled in some markets. Climate risks are no longer theoretical. They're showing up in actuarial tables and mortgage denial letters. Corporate landlords who drove prices into the stratosphere are quietly liquidating portfolios. The migration wave that fueled the boom is reversing as affordability collapses and reality sets in. What was once the American dream destination is transforming into a speculative nightmare where ordinary families are priced out, investors are running for the exits, and entire city economies are built on real estate valuations that cannot and will not hold. The warning signs aren't whispers anymore, they're sirens. And when the correction comes, it won't be a gentle deflation. It will be a brutal reckoning that leaves neighborhoods underwater, both financially and literally. What follows are the 9 Florida cities most vulnerable to catastrophic home price crashes as the market's structural weaknesses finally drag values back to earth. Number 9. Port St. Lucie. On the surface, Port St. Lucie represents the Florida success story, a booming metro that saw median home prices rocket from $285,000 in 2020 to $487,000 by mid-2024, fueled by an endless stream of retirees and remote workers fleeing higher tax states. The population swelled by 23% in just 4 years, making it one of America's fastest-growing cities, and developers couldn't build fast enough to meet demand. In reality, Port St. Lucie is a powder keg of overbuilding and demographic fragility. The city's growth was never organic. It was manufactured by speculative development and artificially low interest rates that turned every vacant lot into a construction site. Now, with mortgage rates hovering above 7% and insurance costs averaging $11,400 annually, nearly triple the national average, the affordability equation has shattered. First-time buyers have vanished. The investment firms that purchased 34% of single-family homes between 2021 and 2023 are now dumping properties as rental yields compress and carrying costs explode. Inventory has surged 67% year over year, yet days on market continue climbing past 95 days, a sharp reversal from the bidding wars of 2022. The city's economy remains dangerously dependent on construction and real estate services, meaning when housing falters, employment craters simultaneously. Hurricane Ian's $112 billion in Florida damages awakened insurers to climate reality, and Port St. Lucie sits squarely in the crosshairs of rising seas and intensifying storms. The median household income of $64,800 can no longer support a $2,850 monthly housing payment when property taxes and insurance are factored in. When this market breaks, and it will, the crash will be amplified by the very speculation that drove prices to unsustainable heights, creating a brutal domino effect where falling values trigger more sales, which accelerate the decline, turning the Sunshine State dream into a foreclosure nightmare. Number 8. Cape Coral. Cape Coral gleams with waterfront promise. 400 miles of canals, endless boat access, and a lifestyle brand that attracted 94,000 new residents between 2020 and 2024, pushing median home prices from $248,000 to $435,000 in a spectacular 4-year surge that made early buyers feel like geniuses and late arrivals feel like they'd missed a boat. Beneath the surface, Cape Coral is perhaps Florida's most precarious real estate market, a city literally built on speculation, where 60% of properties were purchased by investors during the boom, and where the fundamental infrastructure cannot support the population it's already attracted. The canal system that defines the city's identity is also its Achilles heel. Saltwater intrusion is contaminating freshwater supplies, forcing a $1.8 billion desalination and utility upgrade that will slam property owners with special assessments averaging $18,000 per household over the next decade. Insurance companies have fled en masse. 15 providers exited Florida entirely in 2023-2024, leaving homeowners with Citizens Property Insurance, the state-backed insurer of last resort, where premiums have jumped 63% in 2 years and now average $13,200 annually for coastal properties. The math is catastrophic. Median household income sits at $66,200, yet the all-in cost of homeownership, mortgage, insurance, taxes, utilities, assessments, now exceeds $3,400 monthly for a median-priced home. Distressed sales are up 89% year over year as over-leveraged investors and retirees on fixed incomes bail out. The vacation rental market that propped up investor returns is collapsing under regulatory crackdowns and oversupply. Rental income dropped 34% in 2024 while operating costs soared. Cape Coral was never designed for permanent population density, and the infrastructure bill is coming due just as the speculative mania evaporates. When prices plunge, and they're already down 11% from peak, the waterfront paradise will reveal itself as a sun-baked mirage built on canals that don't drain properly and a tax base that cannot fund the services a modern city requires. Number 7. Lakeland. Lakeland positioned itself as Central Florida's affordable alternative, close enough to Tampa and Orlando for commuters, far enough inland to avoid hurricane insurance nightmares, with median home prices hitting $358,000 in 2024 after a 71% increase since 2020 that made it the darling of priced-out millennial families and logistics companies betting on Interstate 4 corridor growth. Dig a little deeper, and Lakeland's housing market is a classic case of borrowed prosperity built on supply chain economics that are already unraveling. The city's recent boom was driven almost entirely by massive warehouse and distribution center construction. Amazon, Publix, and a dozen others built 47 million square feet of industrial space between 2019 and 2023, creating 23,000 jobs that paid just enough, $42,000 median, to qualify for FHA mortgages on starter homes. But the e-commerce explosion that justified this build-out is over. Amazon announced 9,000 Florida job cuts in 2023-2024, and warehouse vacancy rates in the I-4 corridor jumped from 3.1% to 11.8% as companies realized they'd massively overbuilt during the pandemic panic. The housing market followed the jobs. New construction permits are down 58% year over year, yet completed homes keep hitting the market, creating a supply glut that pushed inventory up 103% while buyer traffic evaporated. Property taxes have become confiscatory as Polk County scrambles to fund infrastructure for growth that happened too fast. The average homeowner's tax bill increased 41% between 2021 and 2024, even before new assessments reflect declining values. The affordability calculation has collapsed. A household needs $84,000 in annual income to afford the median home, yet median household income is $58,700, creating a $25,000 gap that can only be bridged by dangerous debts or deferred dreams. Lakeland's lack of economic diversity means when logistics contracts and population growth stalls, nothing fills the void. The correction is already visible in the data. Homes are selling for 8 to 12% below list price, days on market have doubled to 87 days, and builder incentives, free upgrades, rate buydowns, closing cost assistance, signal pure desperation to clear inventory before the market acknowledges what insiders already know. Lakeland overbuilt for a boom that ended before the paint dried. Number 6. Northport. Northport exploded from sleepy Gulf Coast town to one of America's fastest-growing cities, adding 31,000 residents between 2020 and 2024, and watching median home prices soar from $232,000 to $405,000, as retirees and Rust Belt refugees flooded in, believing they discovered Florida's last affordable paradise just minutes from Sarasota's cultural amenities and Venice's beaches. In reality, Northport is a cautionary tale of infrastructure collapse masquerading as a growth story. The city was designed in the 1950s as a planned community that never materialized. It still lacks a functional downtown, comprehensive sewer system, or adequate stormwater management. Yet developers crammed in 6,700 new homes between 2021 and 2024 without the tax base to support basic services. The result is a municipality on the brink. Roads are disintegrating, drainage systems overflow during routine summer storms, and the city's bond rating was downgraded in 2024 due to insufficient reserves to maintain existing infrastructure, let alone build what's required. Hurricane Ian revealed the terrifying truth. 35% of Northport properties suffered flood damage despite being outside official flood zones, and the FEMA remapping that followed pushed 12,000 additional homes into mandatory flood insurance requirements, averaging $8,400 annually, on top of already crushing homeowners insurance premiums of $9,800. The demographic profile is deeply concerning. 41% of residents are over 65, living on fixed incomes that cannot absorb the coming avalanche of special assessments, tax increases, and insurance hikes required to keep the city solvent. Home sales are freezing. Transactions dropped 47% year over year as buyers finally calculate the true cost of ownership and walk away. The investor presence that juiced prices is evaporating. Short-term rental permits declined 34% in 2024 as regulations tightened and occupancy rates plummeted. Northport's per capita income of $31,200 ranks among Florida's lowest, yet housing costs have vaulted into unaffordability territory, where only dual-income professionals or retirees with substantial savings can qualify. The city is functionally insolvent before the crash even begins, and when prices correct to reflect the true value of poorly maintained infrastructure in a climate-vulnerable location with an aging, income-constrained population, the decline will be swift and merciless, leaving tens of thousands of recent buyers trapped in homes worth far less than they paid, in a city that cannot provide the services property taxes are supposed to fund. Number 5. Kissimmee. Kissimmee marketed itself as Orlando's gateway, the affordable entry point to the theme park economy, where median home prices of $371,000 in 2024 seemed reasonable for a metro area with steady tourism employment, and where short-term rental income promised to offset mortgage payments for savvy investors who purchased 43% of single-family inventory between 2021 and 2023. Beneath the surface, Kissimmee is a tourism monoculture facing structural collapse on multiple fronts. The city's economy is grotesquely dependent on Disney, Universal, and hospitality services that pay poverty wages. Median household income is $54,300, creating a staggering $29,000 gap between what local workers earn and what they need to afford the median home. This gap was papered over by speculative investment and short-term rental mania, but both pillars are crumbling simultaneously. Orange and Osceola counties implemented aggressive short-term rental regulations in 2024, cutting legal vacation rental inventory by 38% and cratering rental income for investors who built business models around Airbnb cash flow. Occupancy rates plunged from 76% in 2022 to 48% in 2024, while nightly rates dropped 29% as desperate owners competed for a shrinking pool of visitors. Disney's post-pandemic attendance has plateaued, and the company's ongoing war with Florida over political issues has chilled expansion plans that Kissimmee's growth projections assumed were guaranteed. Property taxes have spiked 37% since 2021 as Osceola County grapples with school overcrowding and infrastructure deficits, while insurance costs averaging $10,200 annually make the total carrying cost unsustainable for investors seeing negative cash flow. The forced sale wave is building. Foreclosure filings jumped 127% year over year as over-leveraged investors and locals who stretched to buy at peak realize they're trapped. New construction continues flooding the market despite collapsing demand. Builders with land contracts signed in 2021, 2022 are compelled to build and dump inventory at any price, adding 4,200 units in 2024 alone, even as existing home inventory swelled to a 10-year high. Kissimmee's fate is tied to a tourism industry facing recession risk, climate disasters that disrupt travel, and a short-term rental model that local governments are actively dismantling. When the correction accelerates, it will expose a city where almost nobody who actually lives and works there can afford to buy, investors are fleeing en masse, and home values were always a speculative fiction divorced from local economic fundamentals. Number 4. Panama City. Panama City Beach's sugar white sands and emerald waters created a spring break brand that evolved into a year-round tourism and real estate bonanza, with median home prices surging from $268,000 in 2020 to $462,000 by 2024, as investors and retirees bet that the redneck Riviera had permanently upgraded to luxury Gulf Coast destination worthy of Naples-level valuations. In reality, Panama City is ground zero for Florida's insurance apocalypse, where the collision of climate risk and actuarial reality is making home ownership economically impossible regardless of purchase price. Hurricane Michael's $25 billion in damage in 2018 was supposed to be the wake-up call, but instead of retreating, developers accelerated building directly on the beach, adding 3,800 beachfront and near-beach condos and homes between 2019 and 2024 in a spectacular display of climate denial and speculative excess. Insurance companies learned the lesson homeowners refused to accept. State Farm, Farmers, and AAA withdrew from Florida entirely, and the remaining carriers now charge Panama City homeowners an average of $16,800 annually for coverage that comes with $50,000 deductibles and exclusions that render policies nearly worthless for actual hurricane damage. Citizens Property Insurance has become the only option for 64% of coastal homeowners, and the state-backed insurer is functionally insolvent, holding just $11.4 billion in reserves against $1.6 trillion in exposure, meaning a single major hurricane could trigger special assessments on all Florida policyholders. The math is catastrophic. A $450,000 home requires a $3,100 monthly mortgage payment at current rates, plus $1,400 in insurance, $620 in property taxes, and $380 in HOA fees, totaling $5,500 monthly when Bay County's median household income is $56,400 annually, making home ownership affordable only to the top 8% of local earners or retirees drawing down savings at an unsustainable rate. Sales volume has collapsed 61% year over year as buyers refuse to sign up for financial suicide, yet inventory has exploded to a 14-month supply as owners panic sell before the next hurricane hits, or insurance becomes completely unavailable. The condo market is in free fall. Units selling for $580,000 in 2022 are listing at $425,000 with no takers, as special assessments for wind mitigation and building upgrades drain reserves and force sales. Panama City's entire economy is a real estate Ponzi scheme, where rising prices justified more construction, which required more buyers, whose purchases validated higher prices. And now the music has stopped. When the crash comes, it won't be because of abstract economic theory. It will be because insurance costs have made coastal home ownership an objectively irrational financial decision, and no amount of beach access can compensate for losing everything when the next big storm arrives. Number 3. Fort Myers. Fort Myers embodied Southwest Florida's renaissance, a cultured Gulf Coast city with art galleries, spring training baseball, and a housing market that seemed to validate the region's ascent, with median prices climbing from $279,000 in 2020 to $448,000 by early 2024, as investors and snowbirds competed for waterfront properties and golf course communities that promised perpetual appreciation in paradise. Dig a little deeper, and Fort Myers is a city still reeling from Hurricane Ian's direct hit in September 2022, where the veneer of recovery masks a housing market built on insurance fraud, federal disaster aid, and collective denial about what living in a hurricane bullseye actually costs. Ian caused $56 billion in damage to Lee County alone, destroyed 5,400 homes, and severely damaged another 14,000. Yet median prices somehow continued climbing through 2023 as disaster aid, insurance payouts, and speculative flipping created a false sense of normalcy. That illusion is shattering. Insurance premiums in Lee County now average $14,600 annually for single-family homes, with waterfront properties paying $22,000 to $35,000 for coverage that includes massive deductibles and wind and flood exclusions. Major carriers have canceled 127,000 policies since Ian, forcing homeowners into citizens or bare-bones private coverage that will leave them financially destroyed when the next storm hits. The investor class that drove prices upward is liquidating. Institutional buyers who purchased 4,200 Fort Myers homes in 2021-2022 are now selling at 12 to 18% discounts to clear inventory before hurricane season, flooding the market with supply that local buyers cannot absorb. New construction permits have collapsed 71% year over year as builders recognize that building in a known hurricane zone with insurance costs that exceed mortgage payments is economic insanity. Property taxes are spiking to fund infrastructure repairs and beach renourishment. The average homeowner's bill increased 44% between 2022 and 2024, with another 15 to 20% hike expected in 2025 as the county exhausts FEMA reimbursements and turns to property owners to fund resilience projects. The demographic mix is alarming. 38% of residents are over 65, many on fixed incomes who cannot afford the coming insurance and tax increases, but also cannot sell without taking catastrophic losses. Fort Myers' housing market was always vulnerable to hurricane risk, but Ian transformed theoretical danger into lived experience. And once homeowners and insurers experience a direct hit, the calculus changes permanently. Prices are already down 9% from peak, inventory is up 94%, and days on market have tripled to 118 days as sellers discover that buyers have wised up to the true cost of owning property in Hurricane Alley. When the correction accelerates, Fort Myers will prove that even the most beautiful Gulf Coast location cannot sustain real estate values when the cost of insuring and protecting property exceeds what rational buyers are willing to pay. Number 2, Orlando. Orlando represents the Florida dream at scale, a dynamic metro of 2.8 million people, anchored to the world's most visited theme park complex, and a magnet for corporate relocations and population growth that pushed median home prices from $289,000 in 2020 to $417,000 by 2024 in a spectacular run that convinced millions of Americans that Central Florida was the place to build wealth and raise families in perpetual sunshine. In reality, Orlando is a speculative bubble wrapped in a tourism economy that's far more fragile than its cheerleaders admit, and the unwinding will devastate tens of thousands of recent buyers who believe the hype. The city's housing boom was built on 3 pillars, and all 3 are crumbling simultaneously. First, the corporate relocation wave is over. Companies that announced Florida moves in 2021-2022 are now quietly reversing course as they discover that low taxes don't compensate for inferior schools, climate risk, and difficulty recruiting talent to a state that's become politically radioactive for educated workers. Second, the investor mania that saw Wall Street firms and mom-and-pop landlords purchase 47,000 Orlando homes between 2020 and 2023 has reversed as rental yields compress and carrying costs explode. Investors are dumping single-family rentals at a record pace, flooding the market with inventory that's pushing median days on market past 75 days and forcing price cuts on 64% of listings. Third, the tourism foundation itself is cracking. Disney's domestic attendance is flat. Universal is diverting investment to Texas and Las Vegas, and the business travel that once filled hotels year-round has been permanently reduced by virtual conferencing. The affordability crisis is acute. Median household income of $67,200 cannot support a $2,980 monthly mortgage payment on the median home, forcing buyers to stretch with adjustable rate mortgages, interest-only loans, and 43+% debt-to-income ratios that guarantee mass default when recession hits. Property insurance averages $8,900 annually and continues climbing as insurers reprice Florida risk, while property taxes have jumped 33% since 2021 as Orange County scrambles to fund infrastructure and schools for growth that happened too fast. New construction is still flooding the market. Developers with entitled land are building through the downturn, adding 18,400 units in 2024 alone, even as demand evaporates and existing inventory reaches a 7-year high. The condo market collapsed first. Units selling for $340,000 in 2022 are now listed at $265,000 with no buyers, as special assessments, insurance spikes, and Florida's new condo regulations create a perfect storm of unaffordability. The single-family market is following the same trajectory, just 6 months behind. Orlando's crash will be particularly brutal because so many recent buyers are over-leveraged and equity poor. 72% of purchases since 2021 had down payments under 10%, meaning even modest price declines will trap owners underwater. When the correction reaches full force, Orlando will reveal itself as a Sunbelt mirage, where tourism jobs don't pay enough to afford housing, investors flee when returns disappear, and the corporate relocations that validated the boom were always more PR than reality. The market that rose fastest and furthest has the farthest to fall, and the fall is already underway. Number 1. Miami. Miami stands as the ultimate symbol of Florida's real estate mania, a global city where luxury high-rises pierce the sky, cryptocurrency wealth floods waterfront properties, and median home prices reached an eye-watering $621,000 in 2024 after a 94% surge since 2020 that convinced the world that Miami was the next great American metropolis, destined to eclipse New York as the financial and cultural capital of the hemisphere. Beneath the surface, Miami is a catastrophic disaster waiting to happen, a city built on a limestone sponge, in the crosshairs of rising seas and intensifying hurricanes, financed by international money laundering and speculative excess, and propped up by a service economy that pays poverty wages to the workers who actually keep the city running. The fundamentals are horrifying. Median household income is $57,800, yet the median home requires $4,500 monthly payments when insurance, $12,200 annually, taxes, $9,400, HOA fees of $650 a month, and flood insurance, $2,800, are included, making homeownership affordable only to the top 6% of local earners or foreign buyers parking dark money in real estate. The insurance crisis is existential. 38 carriers have exited Florida since 2021, and the remaining insurers charge Miami-Dade homeowners premiums that have tripled in 4 years, while coverage has been slashed to barely meet mortgage requirements. Flood insurance is becoming unavailable at any price as the National Flood Insurance Program faces insolvency, and private insurers refuse to write policies in areas where flooding is transitional from occasional to inevitable. The condo market is in complete meltdown. The Surfside collapse killed 98 people and triggered Florida's new condo safety regulations, which are forcing buildings to complete structural inspections and fund massive reserves for repairs. The result? Special assessments averaging $80,000 to $150,000 per unit at buildings across Miami-Dade, bankrupting retirees and destroying property values overnight. Units that sold for $480,000 in 2022 are being dumped for $290,000 as owners flee before the next assessment arrives. The luxury market is collapsing as international buyers vanish. Russian oligarchs are sanctioned, Chinese buyers face capital controls, Venezuelan money has dried up, and crypto bros are underwater after the digital currency crash. Sales of homes above $1 million dropped 52% year over year, and inventory above $5 million has reached an absurd 31-month supply, as sellers discover there are no greater fools left to buy penthouses with views of water that's rising 3 millimeters annually and accelerating. New construction is still adding supply. 22,000 luxury condo units are completing in 2024-2026, even as demand has evaporated, creating a wave of developer bankruptcies and foreclosed properties that will drag the entire market down. Climate reality is undeniable. NOAA projects 12 to 18 inches of sea level rise by 2050, which will make much of Miami Beach and coastal Miami permanently uninhabitable. Yet people are still buying property that will literally be underwater within their mortgage term. The commercial real estate crisis is spreading to residential. Companies that relocated to Miami are discovering that low taxes don't compensate for climate risk, failing infrastructure, political instability, and an education system ranked 48th nationally. And they're quietly moving operations to Atlanta, Nashville, and Charlotte, taking their high-wage employees with them. Miami's housing market was never based on local economic fundamentals. It was built on global speculation, foreign flight capital, and a collective delusion that climate change and inequality don't matter when the weather is nice and the clubs are open. The crash that's coming will destroy generational wealth, bankrupt foreign investors, and leave millions of square feet of luxury condos standing empty as monuments to the hubris of building a modern metropolis on a foundation that's both geologically unstable and climatically doomed. And when the next major hurricane makes landfall, the beautiful illusion will wash away, revealing a city that was always living on borrowed time.